Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Dear ladies and gentlemen, welcome to today's webinar. We are proud to present our new member, Preqin. And today we will have a webinar in cooperation with Preqin. Dave Lowry, Senior Vice President and Head of Research Insights, will be sharing his views on, first of all, methodology of Preqin, but also of impacts of COVID-19 on alternative assets. And both topics, of course, are highly interesting. So I'm really looking forward to this webinar. To let you know right from the very beginning, all slides which will be presented will be shared afterwards, as well as the recording of this webinar. So this will be provided later on after the webinar. You might also be interested, let's check this one. Sorry, I'm just trying to turn the page, which doesn't work. Roland, could you please have the next slide? Thanks. You might also be interested to join other BAI webinars, such as the following: infrastructure-led, aviation, and there will also be another one on trade finance. Please do not hesitate to contact me in case you have any ideas for any other webinars. So this is just to give you an idea of what's coming next. No, Roland, it's slide 3. Okay, 3. Here we go. Sorry. Before I hand over to Dave, I would like to start with a short introduction, of course. As you can see, the whole universe of alternative investments can be allocated to different income types. And I mean, if you are interested to learn more, also on this slide, please don't hesitate to have a look at our newly launched Market Mail. This is a new tool from our association, summarizing all different information all around alternative investment markets and products. You will find a link on this Market Mail. In case you still haven't received it, please let me know. Next slide, please. I mean, what's happening on the market? As you can see, the number of closed deals has been decreasing significantly in 2020, which is of course not surprising. This is especially true for real estate and venture capital. On the next slide, you will see that, of course, also aggregated value of closed deals has been declining a lot, this is also, I mean, like if you have a look at private debt and buyout, you will see there's already a small recovery, but I'm sure Dave will be further outlining what's happening now and what to expect within the next months. Next. Before I hand over to Dave, I would also like to comment on this slide, which summarizes what's happening on the secondary market. I mean, you can see the crisis in 2008, 2009, and the rather fast recovery. And here also, it will be extremely interesting to see how 2020 is going to develop further in 21. But this gives a good summary of also what's happened on the private equity secondary market within recent years. Yeah, with this, I would like to hand over to Dave. Dave, floor is open. I mean, this is the brochure you will be also referring to. So this is why I won't further comment on it. You will do this in much more detail. Thanks a lot, David.
Thanks very much, Annette. Much appreciated. Thank you, Roland, for loading up the slides there. Much appreciated. So good morning, everybody, and thanks for taking the time to attend this webinar today. My name's Dave Lowry, and I'm the Head of Research Insights at Preqin. My plan is to talk through in a little detail about Preqin and the way we collect our data before focusing on the global alternatives market in order to provide some wider context. I'll then drill down into a bit more detail, looking at the key findings from our 2020 Alternative Assets in Europe report, which Annetta referred to, and that details the impact of COVID-19 is having upon the European alternative space. If you have any questions throughout the presentation, please do use the Q&A function, and we'll strive to answer as many as we possibly can. We will be sending a link to today's presentation to all registered participants, and I'd encourage you to take a look through it at your leisure, because there is lots of data and lots of information to go through. So in the interest of time, let's continue. Firstly, for anybody unfamiliar with Preqin, we are the leading provider of alternative assets data with global coverage across fundraising, performance, deals, and LP activity. What does that coverage mean? Well, simply, we have a very large team of several hundred people talking with GPs, LPs, service providers, and other market participants every day. We utilize technology to monitor things like SEC filings, conduct detailed web searches, and have an extensive team filtering out the news and data that our clients need. In hard numbers, it means we monitor almost 50,000 firms, more than 110,000 funds, almost 25,000 funds open to investment, more than 18,000 investors, and we track more than 35,000 funds with performance data, and we've tracked and detailed almost 500,000 deals and exits. We also track more than 600 consultants looking at fund terms across fees and things like that, for more than 34,000 funds, and we have a database of more than 230,000 people and monitor more than 145,000 service provider relationships. In terms of where do we get our data from, personal relationships are really important to Preqin. We receive more than 28,000 regular submissions of data from 6,000 individual GPs every year. On top of this, we've got more than 2,000 hedge fund managers providing Preqin with monthly performance fact sheets and data covering around 3,750 hedge funds. We also have systems in place where when people are submitting their own performance data, where we do believe it might be an outlier, so either very high or very low, it triggers a checking process. So then we'll go and speak to the various managers there, and just to assess the data, and we'll look at individual cash flows across lots of these funds as well. So we do delve down into quite a lot of detail with regards to the funds and the managers that we track. 75% of LPs on the Preqin platform are updated via direct conversations with our researchers. So it is a very labor-intensive process, and we have had long-term relationships with lots of our customers, which really helps us. We also track 60 global news sources every day to provide our clients with the latest trends. We also implemented recently a news automation tool, which will see the number of sources reviewed daily increase to 155. And in fact, we're kind of really confident in our data gathering ability, so that we actually ask our clients to try and catch us out. We have some intelligent algorithms which have been developed internally. Preqin's newly developed news automation tool reads and classifies the alternative assets news. That means that we can expand the volume of news that's checked every day and ensure the latest industry trends are provided on Preqin Pro as quickly as possible. We also offer significant levels of support to our clients. So we have our client services team who are there 24 hours a day, 5 days a week, and we look to try and answer calls as quickly as possible. So that covers Preqin and our data collection process. We do have a more detailed fact sheet available, so if you'd like to see it and read that over time, please do let either myself or your Preqin contact know, because we'd be more than happy to help you. So today I'll be kind of taking a closer look at the global alternatives industry to provide some wider market context, then a more in-depth look at assets under management and fundraising figures to see the real impact that COVID-19's had on the ability for Europe to attract capital throughout this pandemic. I'll then take a deeper dive into the deals being done in Europe so we can have a better understanding of what countries, strategies and sectors have been most impacted, either positively or negatively, by the COVID crisis. Finally, I'll take a closer look at some of the key European markets, highlighting some key figures and trends within these. So to begin at the beginning, let's take a closer look at assets under management and how that's evolved over time. It's important to see exactly where we're coming from with a global perspective. And as you can see, assets under management across the industry have increased significantly in recent years to reach more than $7 trillion at the end of December 2019. So we're at record levels. Given the fund closings since then, we'll be moving towards $8 trillion as the year progresses. This strong performance has been pretty much across the board, with all assets covered by Preqin experiencing huge AUM growth in recent years. Private equity remains the single largest asset class, accounting for almost half of all AUM. The data we have for dry powder is a little more recent, and at almost $2.5 trillion, dry powder is also at record levels. We'll look at the various interplays between fundraising and capital deployment as we go through this presentation, but it's worth pointing out that prior to COVID-19, many investors were highlighting that valuations were at elevated levels, with many asset classes fully valued. What we didn't expect was that the correction which brought, or at least is bringing, the cycle to an end would be a global pandemic of the scale we've witnessed in recent months. The hit to both the supply side and the demand side has been unprecedented. While we shouldn't ignore the human impacts of the pandemic, we will look more closely at exactly how the private capital market has been impacted shortly. Having such large-scale firepower available puts fund managers in a strong position to react when favoured assets do become available, regardless of the size of the asset in question. That said, competition for the best quality assets can still be fierce, meaning that valuations might not be as impacted as they may have been if this wall of capital wasn't available. One of the drivers of AUM and dry powder growth has been the significant levels of fundraising in recent years. In fact, 2019 was the third consecutive year of fundraising hitting more than $1 trillion globally. While fundraising has been exceptionally strong, this capital is increasingly concentrated in a smaller number of funds as they increase in size. Understandably, we've seen a hit to fundraising this year overall, but there have still been several large-scale vehicles raised. It remains to be seen whether we'll hit the heady heights of $1 trillion again this year, but if we do see an economic recovery take hold around the world, and we manage to keep a second wave of infections at bay over the winter, it's not totally out of the question. That said, there are some pretty major ifs and buts within that. 2007 and 2008 particularly were the tail end of the previous cycle leading up to the GFC. At this point in the cycle, there tends to be significant amounts of capital chasing opportunities with pricing relatively robust. During and post the GFC, there was a sharp reduction in capital distributed. This is understandable given the lack of desire to sell at low asset prices and hand back cash. To a certain extent, this same pattern was repeated towards the end of the post-GFC cycle in 2018 and 2019. Distributions remained elevated as pricing was favourable, while capital calls surpassed even these generous payouts as cash was recycled. This is despite investors becoming increasingly concerned about valuations. Given the current environment, it's likely that called-up capital will continue to outpace distributions. Fund managers will be keen to put cash to work in the current environment as they seek to capitalise on any repricing as it happens. This is driving fundraising activity, with record numbers of funds in the market during August 2020. Yet despite and into September 2020. Yet despite the record number of funds, the amount of capital they're seeking has fallen since January, albeit only slightly. There are a couple of potential reasons why this might be happening. Firstly, smaller specialist funds could be experiencing a rise in potential transactions, so are looking to take advantage of this potential once-in-a-decade opportunity. Secondly, in order to capitalize on these opportunities, capital needs to be raised and deployed relatively quickly. If more funds target smaller amounts of capital, they may hit their targets quicker and be able to move fast. There's also the fact that some large-scale funds have closed during the year, resulting in these funds dropping out of the numbers. Of course, in 2020, size is all relative. While $1 billion plus funds represent 70% of capital raised so far in 2020, there has been a notable increase in the proportion of funds raising between $500 million and $2.5 billion. Funds in this band account for 33% of those closed in 2019 and account for 39% in 2020. So it's not a seismic shift, but it is a shift nonetheless. This potentially highlights the desire to raise less capital and deploy it faster. So as a brief summary on the global context, assets under management and dry powder continue to increase and are both sitting at record levels. Capital is increasingly concentrated in fewer hands, be that within specific funds or specific fund managers, and capital calls are likely to outpace distributions. In this type of environment, we'd also expect holding periods to be extended because there's a lack of desire to sell at reduced valuations. The previous slides have provided that global context for the alternatives market, but we'll now drill down into more detail for the European market and look further at trends within asset classes as well as some specific countries. Excuse me. The chart shows total assets under management on an asset class basis from 2015 to the end of 2019, our latest across the alternative assets universe. As you can see, the story across Europe has been one of growth, with AUM exceeding 2 trillion euros for the first time in 2019, growing 42% compared to 4 years earlier. And to put that in context with the rest of the world, global AUM increased 48% over the same period, and US assets grew 38%. So Europe's certainly an important part of the wider global growth story that is alternative assets. We'll start with hedge funds, and this chart shows asset flows since the start of 2015. And in terms of asset flows, this is net capital added or withdrawn to and from European hedge funds every quarter. As you can see, since the end of 2015, the story has largely been one of capital withdrawals. In fact, since the start of 2018, nearly 100 billion euros has been withdrawn from European hedge funds. 2020 started off particularly difficult for European hedge funds as investors withdrew nearly 35 billion euros from the sector. That equates to around 6% of total assets at the time. However, in Q2, the net outflows have been much smaller. So the question for this is, how is this impacting assets under management? In general, we've seen hedge fund assets under management in Europe slide since the end of 2017. AUM growth in the hedge fund sector in Europe has been really buoyed by performance. In Q1 this year, when the performance numbers turned red, coupled with significant outflows, this meant a large contraction in AUM. This bounced back slightly in Q2 due to the improved returns, despite outflows taking it to 562 billion euros at the end of June 2020. However, I think the relative small amount of redemptions in Q2 is an indication of signs of hope. And there's an argument that hedge funds can come out of this quite well. If you look at the returns this year, they've not been too bad. As of August, returns are up nearly 10% in the last 12 months, and hedge funds have, to a certain extent, done what they needed to do in order to help investors through the volatility of the crisis. So in the future, we could actually see investors reevaluate hedge funds in a more positive light as a useful tool in their portfolio to potentially help safeguard assets. However, that isn't translating into any positive flows just yet. Turning now to fundraising, we've seen quite a lot of capital poured into private capital in recent years. The black line here represents the aggregate capital raised, reaching a peak of 247 billion euros in 2019, and the blue bars represent the number of funds closed. There are a few trends at work in this chart. The first is the growing trend for more capital to be raised and for that capital to go into the hands of fewer funds. This is a trend we've witnessed globally, and as I've already alluded to, it's not just a trend that's local to Europe. This means the biggest asset managers are continually getting bigger, and that's continuing in 2020, where the COVID impact is really being felt. The aggregate capital raised in the first half of 2020 is 20% down in compared to the first half of 2019. But going us back a step further, how does this look on an asset class basis? This chart's comparing fundraising in the first half of 2020, the yellow bar, compared to the same period in 2019, the blue bar, with a number of funds closed in each period shown as the orange and grey dots for 2020 and 2019 respectively. As you can see, funds with a focus on European infrastructure and natural resources have been hardest hit. Infrastructure funds closed at just 9 billion euros in the first half of this year, less than a third of the capital raised in the same period last year. However, with a similar number of funds closing across the two periods, it highlights that capital consolidation trend, which we've been seeing elsewhere, is not necessarily happening in all asset classes during 2020. For private equity, real estate and private debt, the picture looks much healthier from the first half of 2020, particularly private equity and venture capital funds, with nearly 10 billion euros closed in the first half of this year compared to 2019. However, I think it's fair to say that how this unfolds over the rest of the year is still up for debate. Europe was hardest hit by the pandemic from March onwards, and many LPs will have made commitments in the first months of the year unimpacted by COVID. Then, moving into Q2, many of those investments would have been decided and due diligence conducted in the months prior. Now is the crux in how do investors select and commit to new managers when they can't meet face-to-face. And this may exacerbate the first trend I discussed, which is that the largest GPs are getting bigger and it's difficult to be a small or emerging fund in this type of market. Although Zoom and online due diligence have become the new normal for many LPs, fund selection still comes down to it being a people and relationship business, and I think many LPs, not all, but many of them, will be wary of investing a fund where they haven't sat in the same room with the manager. So making these new investments will be challenging, and it's why we may see even more capital concentrated in the mega funds as investors have pre-existing relationships with many or all of them. Despite the challenges, it's undeniable that appetite for European private equity has been much stronger than for European hedge funds, particularly in recent years. European hedge fund AUM has been on a gradual downward trajectory since 2017, as we discussed, whereas European private equity continues its relentless growth upwards unimpaired. In fact, private equity took hedge funds' crown as the largest single asset class in December 2018, and as at the end of 2019, private equity outstripped hedge funds' AUM to the tune of 186 billion euros. It certainly seems clear that private equity is on track to become the first alternative asset class in Europe to reach the 1 trillion euros mark. And why is this? The bottom line is that European private equity has been delivering for its LPs over the long term, and investors have recognized this and they want more. Hedge fund performance, in contrast, has proved a disappointment for many investors, particularly in light of the soaring equity markets we've seen in the last decade or so, potentially impeded by a lack of volatility along most of that period. For many investors, the returns they were getting from hedge funds and the price they were paying for it wasn't a trade-off they wanted to make, and therefore we've seen those outflows as investors have culled their exposure to hedge funds in Europe and globally. It's not just private equity that's enjoyed strong growth in recent years. This chart shows AUM over time across infrastructure in grey, real estate in blue, and private debt in orange. European infrastructure and private debt in particular have shown enormous expansion in recent years. In December 2015, real estate was the largest of the three, commanding 172 billion euros AUM compared to infrastructure's 99 billion euros. However, if we fast forward to 2019, and infrastructure assets have expanded more than twofold to reach 219 billion euros, making it the third largest alternative asset class across Europe, behind private equity and hedge funds. Private debt has also been another asset class on the up and up in recent years, doubling in AUM between 2015 and 2019 to reach 179 billion euros. There are signs that it too could exceed real estate by the end of 2020 if the first half of the year's performance is repeated. Investors have shown huge appetite for private debt in recent years, and the COVID crisis and the opportunities this may afford debt managers may only add even more fuel to the flames of this appetite. The chart here shows aggregate capital raised in the first half of 2020 for private debt, infrastructure, excuse me, and natural resources. An aggregate of 21 billion euros was raised by debt managers in the first 6 months of 2020. More capital than was raised in the same period during 2019, with mezzanine and distressed debt strategies being most successful during these COVID times. If this trend continues over the rest of the year, we may see it pick up a spot, number 4, in terms of AUM behind private equity, hedge funds, and infrastructure. So it's clear there's a lot of money has been pouring into alternative assets in Europe in recent years, even if COVID is slowing this down. But where's this money being put to work, and how has the pandemic impacted deal making? In this next section, we'll take a closer look at the deal activity across the private capital asset classes. In 2019, we'd already seen a drop in deal activity across Europe compared to the record highs of 2018, when an aggregate of 450 billion euros was invested in European companies and assets. However, despite the drop in 2019, levels then were similar to 2017, 2016 and 2015, indicating a more normal pace of investments within Europe. In the first half of this year, deals made in Europe are significantly behind where they were last year. Beneath the surface of this, there are a few trends at play, which I'll explore in more detail. The first is that buyout deals have been significantly impacted. In Q1 2020, buyout deal activity was quite robust. However, when the full might of the pandemic was felt in Q2 this year, buyout deals in Europe fell off a cliff. Only 8 billion euros was invested in aggregate, marking it as the worst quarterly aggregate sum invested for at least 8 years. However, in the venture capital space, investments haven't been as badly impacted. Aggregate deal value is down, sure, but by just 10%, although it seems that managers are making fewer but bigger deals, as deal numbers in the VC space are 16% lower than the same period last year. Real estate deals, perhaps unsurprisingly, have shown a significant impact during the crisis, with the 8 billion euros invested in Q2 this year being the lowest quarterly aggregate deal value since the end of 2012. However, on the flip side of this, both private debt and infrastructure are ahead of where they were in the first half of 2020 compared to the same period in 2019. So there's a nuanced picture emerging of certain strategies and assets experiencing a deeper impact than others. As I mentioned in the previous slide, deal making in both the buyout and venture capital space have been very significantly impacted, with both deal volume and aggregate capital invested declining. However, venture capital investments, which have been rising in Europe in recent years, with a record 26 billion euros invested in 2019, have been less impacted by the effects of COVID-19, and we may see more investment throughout the rest of this year as GPs put money to work in new businesses and opportunities that are likely to arise out of the pandemic. So far in 2020, the value of European private debt-backed deals has soared, even though deal flow has declined. There were a total of 79 deals completed in the first half of this year, compared to 197 throughout the whole of last year, for an aggregate value of 8.7 billion euros. This is already greater than the full year value in 2018 and 3/4 of the way to matching the 2019 total. One of the big drivers of private debt deal activity is the refinancing of legacy debt by many corporates and many investors. If they can extend the duration of that debt and potentially cut their interest rate by 200 to 300 basis points plus, it makes sense to do that and take advantage of the sheer amount of capital chasing that sector, which means kind of pricing has been very competitive. In the first half of 2020, aggregate private equity real estate transactions in Europe were valued at just 23 billion euros. That compares to 82 billion euros throughout the whole of 2019. No country or region has escaped unscathed, with Benelux and the UK experiencing the sharpest falls. Despite the various headwinds facing European real estate, particularly across the office and retail space, there are still some bright spots. Industrial and logistics assets are continuing to experience solid investor interest, with yields falling in some cases and strong demand for the best located assets. The rise in online shopping has accelerated during 2020, which means that more warehousing and distribution space is required. And as more people shop online, product returns mean logistics operators require a larger footprint than would otherwise have been the case. It's a well-trodden story across industrial and logistics, but we have seen strong demand across all types of assets for the big regional logistics hubs, smaller distribution centres, and there's also been a sharp increase in the demand for last mile logistics centres. That's likely to continue with the trend for online shopping accelerating across both the world and Europe particularly. With many infrastructure assets exposed to shifting demand in the COVID-19 crisis, there's much uncertainty as to how revenues and profitability will be impacted. Fund managers may be reluctant to commit assets until future demand becomes clearer, leaving dry powder at a record 84 billion euros as of December 2019. With managers holding onto their capital, only 425 infrastructure transactions were completed in the first half of this year, far behind the pace required to match last year's 1,004. Infrastructure deal activity so far this year has been driven by the renewable energy sector, which was responsible for 67% of transactions during the first half. It's likely that that trend will continue, particularly given the the proximity to grid parity for much of these investments, and the rise and increase of ESG and the need for sustainable investment and sustainable funds. We'll now take a closer look at some of the key countries in Europe from an alternative assets perspective. Our recent Alternative Assets in Europe report, which Annette referred to at the start of this presentation, covers in depth 13 countries from across Europe, from the giants of the UK, Germany, Sweden and France, to the small and emerging Norwegian and Belgium industries. Starting with Germany, Germany is becoming a much more established centre for alternative assets in mainland Europe, with alternative assets under management in the country growing 27% in 2019 to reach 75 billion euros. This was largely driven by increases in private equity, up 32%, real estate, up 38%, and infrastructure, up 57% over the course of the year. In contrast, hedge funds haven't managed to escape their reputation as locusts in the mind of some investors, with assets under management dropping to just 4.2 billion euros over the course of 2020. Germany has been leading the way in terms of deal making so far this year, with 34 billion euros invested, making it the highest of any country on the continent. This significant deal flow takes buyout activity to almost the same level in the first half of 2020 as the whole of 2019, with infrastructure investment also looking strong. Like other countries across Europe, private equity real estate deals have been significantly negatively impacted. Just 3.4 billion euros was invested during the first half of 2020, compared to 14.5 billion euros over the entirety of 2019. The UK is the undisputed heart of the pan-European alternative assets market, with assets of 1.2 trillion euros as of December 2019. It accounts for 54% of all European alternative asset capital. UK assets under management saw the greatest increase in private equity during 2019, an increase of 63 billion euros. However, other countries such as France and Germany are sniffing at the UK's heels and are showing faster expansion on a percentage basis as they emerge as destinations for private equity in their own right. The UK is also the undisputed heartland of European hedge funds. The 416 billion euros in AUM represents around 2/3 of all hedge fund assets under management, highlighting the lack of appetite from the UK's continental neighbours. With regards to deal making, for many asset classes, 2018 marked the peak of transaction volumes in the UK, with Brexit and general election uncertainty making the UK investment market less certain. Deal flow significantly declined. As of 2020 commenced, investors were more positive, but the impact of COVID-19 has been undeniable, with the buyout and private real estate deals impacted in particular, with volumes during the first half of 2020 down 76% and 72% compared to the whole of 2019. But there are bright spots. Venture capital and infrastructure transaction volumes are on track to match 2019 levels, if half-one performance is matched in the second half of the year at least. Private debt is probably the brightest star on the UK's investment market, with 2.6 billion euros invested in the first half of this year. It's likely to exceed last year's levels, with the refinancing legacy debt, as I've already discussed, a key driver. In terms of fundraising, UK-based GPs have been hit hard in 2020, and fundraising in the first half of the year is down 36% compared to the same period last year. Turning now to France. France is the leading centre for alternative assets in mainland Europe, with 242 billion euros in AUM, growing by 50 billion euros or 26% throughout 2019. The country is home to many large asset managers, and the French ecosystem is rich with GPs and LPs actively investing across all asset classes. Infrastructure in particular saw strong growth throughout 2019, growing by over 14 billion euros, taking France's share of European infrastructure assets from 20% to 25% as at the end of last year. We also witnessed significant growth in French private equity and French private debt assets. Buyout and venture capital deals look on track to beat 2019, with infrastructure and private debt deals in France already higher in 2020. Private equity real estate deals were the hardest hit as a result of COVID-19, and half the capital invested in France real estate in half on 2020 compared to the first half of 2019. The severity of the lockdown in France at the height of the pandemic, which hit activity across a wide range of sectors, has resulted in weaker valuations and reduced demand for assets overall. The results of this can be seen in the chart and on the top right of the screen. This is a list of the 5 largest private equity real estate deals in France in 2019 and 2020, and 4 out of the 5 were made last year. Finally, fundraising for France-based GPs has been strong in 2020 despite COVID-19 and is on track to match, if not surpass, 2019's record levels, accounting for 30% of all capital raised in the first half of this year compared to 25% in the same period of 2019. So finally, to summarise, a few thoughts from me on the findings of the report and a bit more generally. Alternative managers in Europe continue to be active despite the COVID-19 crisis. The data that Preqin has shows that despite the COVID-19 pandemic dampening activity, it hasn't extinguished it entirely. Deals are continuing to be made, although at lower than the levels in the same period of 2019, and funds continue to be raised, albeit around 80% of the level compared to the same period last year. I think it's now that managers and investors alike are finding their feet with restrictions in many parts of Europe having been lifted, albeit with localized restrictions that may be put in place. And therefore, we think in the future, there may be an uptick in activity as the initial challenges of COVID-19 felt hardest in particular during Q2 and Q3 2020 may be being eased. But only time will tell. No one knows what the future will hold for the pandemic during the winter months, and certainly the rising cases in many parts of Europe may thwart some of the hubs that we have at Preqin. However, the crisis may exacerbate the differences between the haves and the have-nots. As I've already discussed, a key trend that we've seen in recent years is that even though more capital is raised annually, it's going into the hands of fewer GPs. COVID-19 and the challenges that poses investors may see a continued flight to just the biggest managers. This may mean that for smaller, new or emerging managers, it will be difficult to gain traction in this market. This is a real shame, as it's often in this part of the market where the new and exciting innovations are happening, and it's these innovations and new products that can really help LPs. Investors should continue to invest throughout this crisis. Our sense is that investors today are very different to how they were a decade ago. LPs across the European community are much more sophisticated these days and much more educated than they were back at the time of the GFC. Investors have built large, diverse and complex portfolios of funds, and their overall portfolios and returns are better off for it. Yes, like everyone, the COVID crisis caught LPs off guard, but we have seen them respond in terms of changing working practices to cope. And although there are challenges when it comes to fund selection, which may, as I mentioned, lead to more consolidation, we don't foresee investors putting all commitments on ice. In fact, investors in Europe are continuing to put fresh capital to work. Managers have also responded quickly to this crisis that emerged at breakneck speed. The response has been very different to that witnessed during the GFC too. Investors we've been speaking with really have been praising managers for being available, explaining exposures, and answering several questions. Turning back in time to 2008, it was probably exactly the opposite. And fundamentally, the alternatives landscape now is bigger, much more institutional and secure, with robust infrastructure and systems in place. I think these changes enabled managers to adapt quickly, and this is reassuring to investors. Alternative assets have their part to play in helping the world recover from the devastating human and economic fallout of the pandemic, both through how GPs have worked with their portfolio companies and assets to, for example, reduce rents, defer interest payments, and in general guide these companies through the crisis, as well as by investing in technologies, medicines, and things like that, that may be key to getting the world back on its feet. Overall, although the COVID-19 pandemic is clearly having some short-term impacts on European alternatives, we do think the industry will not only weather this, it will thrive afterwards. The true impact of COVID-19 might be one of more change and growth in the alternative space. The reason the industry has shown so much growth in the past is that alternative fund managers have been able to rapidly adapt and evolve to changing environments. Will we see the emergence of new assets? The private debt sector, for example, we see now was really born out of the GFC, or will we see new products in the wake of this pandemic? My gut feeling is that we probably will. So with that, that's my presentation. Our more detailed European report is available via our website, so please do take a look if you can. Thank you for listening. I know there's lots of information contained in there. For now, though, I'm happy to open up to any questions we may have, So I'll hand back to you, Aneta. Thanks very much, everybody, for listening. It's very much appreciated.
Great. Thanks a lot, Dave. This has been extremely interesting and was providing a comprehensive overview of what's happening in Europe, what's happening against the background of the crisis. I have a few questions. Maybe I would like to start with one referring to the first part of your presentation and how data processing is done in Preqin. So could you please comment, how do you avoid any biases if you're analyzing data?
To be honest with you, it's a really good question, and I think the way in which we've been going about improving our data collection process, we have lots of people kind of working on this as well. We have very detailed internal systems, so when we're inputting data, following contact with our various GPs, LPs, and service provider contacts, we have internal checks and balances, which every time a new data input is added into our system, if it looks erroneous, then there's a flag, and there are further checks of that data as well. Particularly on the performance side, we have lots of data submitted by managers themselves, so then that's double checked by our software, which we've automated to do that. If there's a higher or a lower figure than expected, or there seems to be a bit of an outlier, that triggers a checking process as well. And we do verify as much of this data as possible, particularly on the performance side, by getting cash flow details from the various managers that we track. And again, this is kind of checked, goes through our internal systems that we've built up over a number of years to try and avoid any kind of bias within this.
Okay, thanks. Then another question. You have been asking or recommending investors to continue investing even against the background of the crisis. This is understood, but at the same time you had been presenting the slide on dry powder. I mean, this is enormous amounts. So what's your opinion if there will be even more money be added to this, and dry powder still even more increasing? Of course, this will have impact on values. So in a nutshell, do you see the risk of bubbles in all this, or what's the outcome of this development?
Yeah, to be honest, I think it's a very good question. In the past, we've seen that, particularly for fundraising, recession-era vintages tend to outperform because you get quite a significant adjustment in pricing, which makes for attractive entry points for the funds that invest throughout times of hardship for some companies. Given that the response of various governments around the world to the pandemic has been very different to that which we saw throughout the GFC, we've seen significant government intervention in markets. We've seen generous handouts to various electorates. We've seen company bailouts and things like that. So to a certain extent, we've been kind of cushioning the impacts of the pandemic so far. The impact has obviously been very, very hard because it was both on the supply side and the demand side, and the sheer shock of it hit really hard. But I think that given the government interventions and central bank interventions that we've seen, valuations across many sectors might not really adjust to levels that some initially expected. So I think that might mean that there's still competition for the best quality assets, which might mean that valuations aren't hit particularly hard. It might mean that the vintages from this year aren't significant outperformers like we would have expected in the past. And I think that you will still see some very good quality companies or some very good quality assets that might experience some short-term cash flow difficulties as a result of COVID, but which have some pretty robust long-term solid business models. And so I think investors will be targeting those types of assets. So there should still be plenty of potential transactions where this dry powder can be put to work. And I think on the fundraising side, lots of capital will still be being attracted, because if you think that the alternative investment markets, you have public equities, which are priced relatively expensively across the world at the moment, it could be argued. You've got fixed income markets where central bank intervention is likely to mean that yields and returns there are lower for even longer. So it makes alternative assets still very, very attractive from a relative risk and return basis. So I think that is what will keep driving activity through as well. And we're kind of seeing lots of activity across certain sectors. So it's a well-trodden path, and we've discussed it lots throughout the pandemic, but we're seeing health tech as something that's going to see an increased investor demand. Certain types of real estate, such as industrial and logistics, are still experiencing increased demand. And I think we're going to get some more niche sectors, such as data centers as well. Investors are really keen to get exposure to. some of the potential winners from the pandemic. And if you think of the amount of data creation that we have now, people working from home, doing webinars, Zoom meetings and what have you, then data centers, they've been classed by many countries as essential infrastructure. And if you want to generate returns in the double digits and above, then investing in a data center operating platform is something that could potentially be really interesting in this type of market. And we've seen lots of GPs start to target this sector as well. So I think that type of activity will keep dry powder kind of under control, but I think it will also mean that fundraising is still relatively solid in the future as well, because there will still be lots of opportunities out there.
Okay, thanks. Thanks for this. Another question is, from the audience, do you expect that the hedge fund sector will be performing better than other alternative funds in the next years?
Yeah, again, it's another interesting question. And I think for hedge funds particularly, market direction isn't necessarily the thing that drives their returns. It's often market volatility. So depending on whether we see some additional volatility across markets, either on a European basis or on a global basis, then I think hedge fund returns could potentially start to look a bit more interesting and could potentially be boosted by additional volatility in markets. And I think if they can prove their non-correlation of their returns, depending on the strategies that they invest in, then I think we could potentially see a bit more activity on that side, to be completely honest with you.
Okay, thank you. You also mentioned further concentration in fewer hands. Let's just wait a sec. David? David, we can't see you anymore. Can you?
I'm sorry, yes, yeah, I think I take technical issue there. My apologies.
Sorry, just one further question. You have been mentioning further concentration in fewer hands with respect to asset managers, of course.
Yes.
I mean, this is a development which will be increasing against the background of the crisis. It had been there already before the crisis in a way, but now, of course, it's further evolving. But what do you see this one as a long-term trend, or where do you think this trend is going to end?
Yeah, it's a very good question. I think certainly in the short term, we're likely to see more of it, because it is really good if you can, as I kind of alluded to in the presentation, sit down with the managers of a fund that you're seeking to invest in. And it could be the case that lots of the capital raising and fund commitments that we've seen throughout this year are based on discussions that were happening prior to COVID hitting activity. It might be relatively difficult for a smaller or niche or a first-time fund to go and raise capital in these types of markets, but it's not impossible. I think if you're cultivating relationships on a long-term basis, which many managers do, then people know who you are, they know how you operate, and you've potentially proven your systems in the past. Long term, I think the larger asset managers will still account for a very large amount of capital going towards them, because I think that they're just creating their own centre of gravity now to a certain extent, particularly across certain strategies. So I don't think that trend's really going to go away. But I think for smaller funds, it creates potential opportunities that they might be able to, in the future, raise capital faster, deploy it faster, and be a bit more nimble, and potentially be a bit more niche in the types of investments that they do start to target.
Okay, thanks. Another question was referring to page 25. Maybe, Roland, could you scroll back to 25, please? You had been mentioning the strong increase in debt.
Yes.
In private debt, of course. So could you let us know maybe some more details? What kind of debt? Is it more senior, junior, distressed, whatever other sub-strategy? Or also in terms of average term of these loans. Is it something you can give us some more insights on?
I can certainly talk about the sectors that are being targeted, and to be completely frank, it is more distressed opportunities which are emerging in the market at the moment. So that's what's driving a lot of the private debt, both capital raising and deployment. As I was kind of saying in the presentation, there are lots of potential opportunities out there on the distressed side, kind of good quality companies generally, that are experiencing some real kind of hardship in terms of cash flows. And this is across assets that were previously deemed to be relatively secure and relatively robust. So that's what's driving a lot of that activity, to be completely frank. But we're also seeing corporates can take advantage of the sheer amount of cash in the private debt market as well to try and refinance their balance sheets. We've got lots of legacy debt, which might be priced at 5% plus with maturity dates in the next few years. If they can kind of lean on the private debt market to refinance that debt, potentially saving 200 to 300 basis points from their overall bill, and extend that maturity out from saving maybe 3 years to 10 to 15 years, then that's what's driving a lot of activity, and a lot of that's kind of senior debt as well.
Thank
so
you very
it's
much.
a sector where we expect that activity to continue.
Okay, do you also have any view also how co-investments have been developing within recent months?
To be honest with you, I think there's lots of investments into, particularly co-investments, things like that. We've actually kind of seen a lot of that put on hold, and a lot of the transactions that have been agreed have been those that were executed or due diligence committed and conducted prior to COVID. So I think throughout some markets, particularly on the larger co-investment side, there's been a bit of a dearth of activity across many of the asset classes that we cover. So I think that's probably something that we need to watch out for in the latter half of this year and into next year, just to see exactly how due diligence can be done, how relationships there can be formed, and what types of assets these companies do start to go for.
Okay, thank you very much. Then referring to page 34, Roland, maybe we can see this one again, because this is a Germany page. On this slide, you have been summarizing all kinds of data in Germany. So since everyone is always curious where this data comes from, maybe could you just give us some more ideas of how you work if you are summarizing and collecting data for slides like this?
Yes, of course. So as and when we're collecting data, we speak to, as I say, we have thousands and thousands of relationships with GPs and LPs across the world. And as and when we're collecting the data, we'll tag a particular fund or fund manager for their location. We'll have a look at where the fund is investing. So we'll kind of draw on all of this kind of data tagging that we do throughout our data collection process. And then we kind of also speak to the various managers, GPs, LPs individually. And then we also work with industry associations such as yourselves to try and kind of engage with as many market participants as we possibly can. It is the case that we're always adding new data onto our platform. It's not a static database, it's constantly evolving. So as and when we kind of do gather new data and more data, it's always reflected immediately within our platform. So a lot of it comes down to these existing relationships, new relationships, and the tagging of the data as and when we get it. And then it's aggregated on a regional and on a country and on an asset class basis that way.
Okay, thank you very much. I think, Roland, do you see any other questions from the audience? I can't see any, but is it just,
no.
Do you see any other?
No.
No. No, there's one additional, and this is why. Why has hedge fund performance? Let me just check this one. It doesn't open. So disappointing in H1 2020, given the fact that volatility was very high. Sorry for this, it's difficult to read. But this was a question. I mean, it's about hedge funds performance in 2020 so far, and it seems to be a little disappointing in terms of existing volatility. Yeah,
I think it's a very good question, and I think a lot of that is the kind of the timing of the volatility as well. Everything was kind of really hit in the latter half of, in the latter part of Q1, which is when markets really started to equity markets, that is, were hit as with lots of countries around both Europe and around the world entered lockdowns. So if you look at a lot of the data that we have on a quarterly basis, Q1 was actually relatively strong for some, but then the volatility didn't hit hedge funds until the back end of Q1, and up to that point there was kind of lots of talk about what might be happening with COVID as it was emerging around China and APAC at that time, but there wasn't a huge amount of volatility in the first part of that quarter. I think when the full extent of the pandemic hit Europe was towards middle or end of March, and I think that's when the market, and again it wasn't volatility as such, it was just a downward spike, which then we kind of experienced a bit of a recovery into Q2. So I think that type of activity and that type of pattern isn't really kind of great for a lot of the hedge funds, and they were maybe kind of positioned in a way in which they were hit relatively hard rather than positioned to benefit from it. And I think in Q2 some kind of harsh lessons were learned, and I think hedge fund managers particularly are kind of building upon those lessons.
Okay, thank you very much, David. I think we don't have any further questions. So thanks a lot for taking the time and having this presentation with you. It was extremely interesting. And yeah, hope to hear from you soon, let's say it this way. I think it will be extremely interesting to have updates on this from time to time. So thanks again to you and your team, and have a nice day. And to the audience, also to you, have a nice day, and hope to welcome you again to another BAI webinar soon. Bye-bye.
Likewise. Thanks very much, Annette. Cheers. Thanks, everyone.